So, shares in alternative asset manager Blue Owl Capital closed almost 8% lower after announcing it would curb investor liquidity along with the sale of $1.4 billion in loan assets. The sale of loan assets, which amounts to 30% of its total assets, will be used to pay down debt and return capital to shareholders of one of its funds. Now, the news has sparked fresh concerns in the world of private credit.
Something is building in the American financial system right now that the president spent 2 hours at the State of the Union pretending does not exist. And the people who study financial crises for a living are using a specific comparison that should make every American who remembers what happened in 2008 pay very close attention. They are calling this 2006, not 2008, not the crash, the quiet period before the crash, when the structural cracks were already visible to anyone willing to look directly at them. When the official narrative was, everything is fine and the stock market is going up. When the people who saw what was coming were being dismissed as alarmists, right up until the moment when they were not. Make sure you're subscribed to The John Brown Show, because what I am about to walk you through is the most important economic story that received 0 seconds of coverage during Trump's State of the Union address. He mentioned the stock market 3 times. He did not mention this once. And the reason he did not mention it is that what is happening in the shadow banking system right now is the direct product of deregulation decisions his administration is actively accelerating. Removing the warning systems, opening the doors to retail investors, dismantling the oversight architecture, all while the stress signals are already flashing in the data for anyone paying attention. Here is what just happened at 2 major financial institutions in February 2026. Right now, this month, Blue Owl Capital is one of the largest private credit platforms on the planet. Not a fringe player, not a boutique operation, a flagship name in an industry that has grown to somewhere between $1.8 and $3.5 trillion in assets. Blue Owl locked investors out, halted redemptions from one of its vehicles, restricted liquidity, then sold $1.4 billion in loan assets, representing 30% of its total holdings, to pay down debt and return capital to shareholders. The market responded immediately. Blue Owl stock fell 30%, and it dragged down major firms across the sector, including Apollo, KKR, and Blackstone, because investors started asking the obvious question: if this can happen at Blue Owl, what is happening everywhere else we cannot see? Share this video because the UBS situation happening simultaneously answers that question in a way that financial professionals are describing with a phrase borrowed from Jamie Dimon, the CEO of the largest bank in America. Cockroaches. Where you see one, there are almost certainly more. UBS sits at the intersection of traditional banking and private credit through investment vehicles it manages. In February 2026, UBS told its clients it had to write down assets in those credit funds. One key investment representing approximately 5% of assets took particularly severe losses. Earlier reporting had indicated UBS could face more than $150 million in losses on these funds after projecting roughly 70% recovery on more than $500 million of loan exposure. And UBS strategists themselves are now openly warning that in a worst-case scenario, private credit default rates could reach 15%. Think about what 15% default rates in a market that has $3.5 trillion in assets means for the broader financial system. And think about the fact that this warning is coming from UBS's own strategists. This is not an outside critic raising alarms. This is the institution itself telling its own clients that the worst-case scenario they are modeling involves default rates that would be genuinely catastrophic. Make sure you're subscribed, because to understand why this matters so much right now, you need to understand what the shadow banking system actually is and why the guardrails that were supposed to contain it are being systematically removed. Private credit is lending that happens outside traditional banks and outside public bond markets. Instead of a company going to a regulated bank for a loan or issuing publicly traded bonds, they go to a private credit fund. That fund raises money from pension funds, university endowments, wealthy individuals, and institutional investors. Then it deploys that capital by making loans directly to companies that are too big for community banks, but not quite safe enough to access public bond markets at favorable rates. The key word in that description is private. These loans do not trade on public markets. They are not subject to the same transparency requirements that govern traditional bank lending. They are not required to update their valuations more than their fund documents require. 80% of private credit assets sit in closed-end private funds with no public reporting, no standardized disclosure, and no requirement to mark assets to market in real time. This means the only time anyone gets a clear look at what is actually inside these portfolios is when something breaks. When a borrower files for bankruptcy and the loan terms become visible through court proceedings. When a publicly traded business development company releases earnings that reveal distress. When a firm like Blue Owl locks investors out and the market forces the question into the open. Share this video because what is already visible in the public data suggests the private data is significantly worse. Payment in kind lending, PIK. This is the mechanism that allows a borrower who cannot make cash interest payments to simply add the unpaid interest to the principal balance of the loan instead. The loan appears stable on paper, the lender books income, but no cash is actually changing hands. The borrower's debt is growing, and the lender's asset is deteriorating in real terms even while it appears healthy on a balance sheet. As of mid-2024, nearly 12% of loans held by business development companies involved PIK arrangements. Industry insiders suggest the real number by 2025 is closer to 15%, and a review of these arrangements found that 57% of PIK deals examined were not structured as PIK from the beginning. They were amended into PIK after the original borrower started struggling. More than half of the PIK arrangements in the visible slice of the market are distress modifications masquerading as regular loan management. When you model the true default rate accounting for these shadow modifications, the number is not the official reported figure. It is closer to 6% of the total market, several times higher than what the public narrative acknowledges. Think about what the 2008 comparison actually means in this context. Before that crisis, the official story was that mortgage-backed securities were stable, diversified instruments spreading risk across the global financial system. The unofficial reality visible to anyone who looked at the underlying loan quality was that leverage had been piled on top of leverage, that the borrowers at the foundation of the entire structure could not actually afford what they had borrowed, and that the ratings and valuations applied to these products bore no relationship to what would happen when the music stopped. Make sure you're subscribed, because the regulatory dismantling happening simultaneously with these stress signals is the part of this story that transforms a concerning financial situation into a potentially catastrophic one. After 2008, regulators built a framework designed to prevent a repeat. Capitalization requirements, stress tests, transparency rules. The Financial Stability Oversight Council specifically created to monitor system-wide financial risks and make calls about how to mitigate them before problems become crises. Under this administration, the Financial Stability Oversight Council has been explicitly repurposed. The Treasury Secretary sent a letter articulating a new FSOC philosophy. Greater financial stability can be achieved by reducing regulation and promoting economic growth. The council that was created to catch the next crisis before it becomes a crisis is now being directed to find regulations that impose undue burdens and remove them. The warning system is being pointed in the opposite direction from the warnings. The Securities and Exchange Commission under the Biden administration had passed a rule package requiring standardized quarterly reporting from private credit funds, annual audits, restrictions on the sweetheart deals that allow favored investors to get better terms than everyone else, the kind of sunlight that might allow regulators to see what is happening inside these portfolios before it becomes a crisis rather than after. The Fifth Circuit struck those rules down after the industry lobbied against them. The Trump-appointed SEC leadership has shown no interest in rebuilding any version of them. The transparency architecture that might have allowed regulators to detect what is happening in private credit before it reaches Blue Owl lockout territory has been deliberately cleared away. Share this video because the decision to open private credit markets to retail investors while simultaneously removing oversight represents the most dangerous combination of these factors. An executive order directs the Department of Labor to allow private credit and private equity into 401k retirement plans. The savings of ordinary working Americans. The money that middle-class families have accumulated over careers of work and careful investment, being directed into a market that is operating without the transparency requirements, without the standardized reporting, without the oversight architecture that would allow anyone to know whether the products being offered are genuinely sound or whether they are the 2026 equivalent of the mortgage-backed securities that wiped out 10 million families in 2008. In principle, the idea that ordinary investors should have access to investment opportunities that were previously limited to institutions and wealthy individuals is not unreasonable. But access without protection is not democratization. It is exposure. It is inviting people whose savings represent their entire financial security into a system where the rules that would protect them from predatory or reckless lending have been systematically stripped away at exactly the moment when stress signals are appearing throughout the sector. Think about what happened to the families in 2008 who were told that the mortgage products they were being offered were sound, who trusted that the system had guardrails preventing lenders from selling them products designed to fail, who found out that the guardrails had been quietly removed while the official narrative kept insisting everything was fine. 8 million Americans lost jobs. 10 million families lost homes. The people who caused it were bailed out. The people who suffered from it were told to be patient. Make sure you're subscribed because the connection between this financial reality and Trump's State of the Union boasts reveals the precise nature of the deception being practiced on the American public. He mentioned the stock market 3 times. He said tariffs were one of the primary reasons for the biggest economic turnaround in history. He said the Dow broke 50,000 and the S&P hit 7,000. He said drug prices are the best in the world and healthcare is essentially solved. He mocked the concept of affordability as though the 68% of Americans who say their financial situation has gotten worse are experiencing a collective delusion. He did not mention deregulation. He did not mention the shadow banking market. He did not mention Blue Owl locking investors out. He did not mention UBS warning of 15% default rates in a worst-case scenario. He did not mention that the Oversight Council created after 2008 to prevent a repeat has been repurposed to remove regulations rather than enforce them. The stock market is not the economy. This point cannot be stated often enough. The stock market is a measure of the expected future profits of large publicly traded companies. It has limited direct connection to whether families can afford groceries, whether workers can find jobs, whether the credit system that underlies every aspect of economic activity remains functional. What destroys economies is not stock market declines in isolation. What destroys economies is what happened in 2008. Credit tightening, banks absorbing losses and reducing lending, businesses unable to borrow for payroll or expansion, families unable to get mortgages, the credit-dependent economy seizing up and contracting. Share this video because the people most at risk when this resolves badly are not the institutions. They never are. The institutions that caused 2008 were bailed out, made whole, given the liquidity they needed to survive. The families who lost homes and jobs and savings were told to wait for the recovery. The political failure of that response is arguably a direct line to every populist election outcome in the years that followed. People who felt that the system protected the powerful and abandoned everyone else expressed that feeling in every election they could. Now the guardrails that were supposed to prevent a repeat are being removed. The oversight architecture is being redirected. The warning systems are being turned off. And retail investors are being invited into a market where 15% default scenarios are being modeled by the institutions managing the money. The stress is building, slowly and then potentially catastrophically all at once, exactly the way it built before 2008, exactly the way the people who were right about 2008 described watching it build before anyone was willing to say out loud what they were seeing. Michael Burry almost went bankrupt waiting for 2008 to arrive after he saw it coming. Being right about a structural problem in a leveraged financial system is not enough. You have to survive long enough to be proven right. The question for everyone with money in a retirement account, everyone who needs a mortgage or a car loan or a small business loan, is not whether the stress building in private credit markets is real. The data says it is real. The question is whether the people who were supposed to be watching have been replaced by people who have been told to look away. The cockroaches are visible. The ones we can see are at Blue Owl and UBS and in the PIC data and in the net asset value declines. The ones we cannot see are in the 80% of the market operating with no public reporting requirements. In 2006, the official story was fine. We know how that ended. This story is just getting started. Stay tuned.